Welcome back, my wonderful people. I haven't seen you for a few weeks and I missed you guys a lot. Hope you're doing well. If you're new to my channel, welcome. I'm Larry and I'm a strategist who's here to help you navigate markets. I mostly focus on macro, equity research, and portfolio strategy, while sometimes talking about life and philosophy on my channel. If you've been following me for a while now, great to see you again. Let's get back to work. We're talking about investment strategy today, and more specifically, an updated outlook on the health of the consumer in the US and inflation for 2022 and what it means for equities. Towards the end of the video, I'll talk about what themes I believe may have run its course and which themes may provide an opportunity for alpha later this year. And I'll also provide a brief update on the Chinese internet sector, which I know a lot of my international YouTube friends are very interested in. Now, the research and insights from today's video will be an update on a previous inflation research video I did about 3 months ago. So if you're a beginner in investments or inflation, I recommend watching that video first. Okay, let me first give a recap of what performed well in 2021 and what didn't do so well. And this recap is important because it sets the tone for how things are likely to play out for at least into the first quarter and even second quarter of this year. Now, as a reminder, my research and analysis is designed to be more intermediate term in focus. No one can predict exactly what happens in the short term, and honestly, very few people can understand what happens in the long term as well. So my research is based on the intermediate term. Now here I've created a table of theme baskets of in-favor strategies and out-of-favor strategies during 2021. And you can see that within the in-favor theme baskets, we had the FANG stocks, the mega cap stocks, cyclicals, economically sensitive companies, energy and financials, and also a portion of the consumer leaders sector. And within the out-of-favor baskets, we had Chinese internet, a lot of the high growth multiple companies, and ARK related stocks. Now, what's important for investors to recognize is that my official view that I'll make on YouTube is that I believe the market now moves based on themes. I don't just think it's based on sectors, I think it's based on themes. So if you're in the right theme, it largely doesn't matter what companies you're in, you'll mostly do well. Now, what drove some of these themes to be in favor last year? As you probably remember, we had the great reopening, we had the 10-year yield rising again, and we had consumer spending and jobs being bullish for the economy. And what drove some of the underperformance for the out-of-favor themes? Well, we had a rapidly changing landscape in China in its regulatory practices, and there were inflationary pressures that would later lead to a more hawkish Fed, and also a capital allocation away from high growth multiple tech companies. Now that brings us to where we are today. And while anything can happen, I do believe that the research I'm referencing today will be relevant for at least the first quarter or two of this year. So I'm now going to tie last year's investment narrative to where we're going next by giving you an analysis of the Fed's December press conference. And I'll do a follow-up community post on the Fed minutes if anything was critical, so make sure to check my YouTube community section. Now, in Jay Powell's December meeting Q&A section, many reporters and analysts asked some really important questions. Is the Fed behind the curve? Will the Fed raise rates before tapering is over? Will there be a balance sheet runoff after tapering? And what is the Fed's view on the inflation outlook? And I've listed Jay Powell's responses to most of these questions. And my key takeaways from his responses is that I do believe that the Fed has moved away from peak dovishness, but I firmly believe that the Fed is still very sensitive to financial conditions while trying to balance keeping inflation under control. Now, this means I interpret the Fed as still being accommodative to the broader stock market for at least the first quarter or two of this year. After that, How accommodative they will be will depend on the consumer health and inflation outlook, which is what I will talk about now. Now, in previous videos, I've spent a lot of time talking about the composition of core PCE inflation. And as a reminder, what makes up core PCE inflation, which is one of the factors the Fed uses to make decisions, is in this table here. And you'll notice that some of the largest weightings include housing. And within one of the faster growing components, we have auto and vehicles. Now, these two areas are highly dependent on the health of US consumers. I have a couple charts to show you that the health of the US consumer is currently solid, but some cracks are starting to emerge. Now here we see an image of the household debt service as a percentage of disposable income. Now this data does have some quarterly lag, but you can see that early 2021 was when the consumer was honestly in the best shape from a personal debt perspective. We can see that even though the data shows that the chart is still lower than pre-pandemic data because of all the stimulus, the chart is ticking up again, which means that debt is becoming a bigger part of income within households. This will most likely be felt in consumer confidence across the board in the coming quarter, so be aware of that. Another chart that I like to use when understanding consumer confidence is the personal savings rate. We see a lot of media outlets talk about Americans having stronger net worths than in the past, but most of that net worth increase is from illiquid equity like real estate and also paper gains from the stock market. Now, the personal savings rate is already back to pre-pandemic levels, meaning that US consumers are struggling to save money at the same rate that they were during stimulus. Now, on the bright side, we're seeing mortgage delinquencies declining, and that's a very important metric to follow because this means that fewer people are missing their principal and interest payments on their mortgage. Now, of course, we still need to see how these data points play out since the mortgage forbearance programs are largely over. But for now, it seems that we're mostly moving in the right direction. So while there is a very strong stock market right now, there seems to be a much more mixed picture in the real economy itself. So during my 3 weeks of holiday vacation, I was spending time with family, working on my soon-to-be released Patreon. I also spent a week in Florida and also went to the Foxwoods Casino. Now, travel and leisure was in full swing as flights were completely booked and local restaurants in Miami's tourist districts were almost always full. But I can only speak for the tourist destinations. Foxwoods, which is a casino establishment here on the East Coast, on the other hand, I was shocked to see that nearly 1/4 of gambling tables were vacant on New Year's Eve. And the slot machines, it wasn't very well occupied as well. Now, I know my personal experience is anecdotal, but it seems to support the data that I've been seeing, that certain sectors are doing very well. And within certain sectors, it's very selective in terms of which companies. And that broadly speaking, middle America is still under a lot of stress compared to the more well-heeled demographic. Now, I also see comments from my previous video where I talked about my career. And some of the YouTube friends that we have here made comments that their current jobs are stifling their growth and stagnating their careers. Now, some companies perhaps are not in the position to provide more opportunities to their employees, especially if they're not market leaders. Now, if you are in that position, I will do my best to provide advice on my channel that will help you. Now, for me personally, I am quite concerned about the real economy itself. I just simply don't buy into the story that the demand side of the inflation equation is that strong. Sure, it's solid, but it's not as strong as portrayed in the media. I did do a poll several months ago about the strength of the economy to you guys, and I believe that my primary data is more accurate than the media narratives. Now, I definitely agree with the supply side inflation story though. The supply chain disruptions are real. The real cause of inflation being stubbornly high is increasingly a supply side story. And now, We have 1 million COVID cases per day in the US, and even though hospitalization rates are low for the new variant, this mere fact may prevent the labor force from ever reaching full employment while inflation continues to be a stubbornly high issue. Now, as you know, China has a zero COVID policy, and the rapid increase in cases threatens to worsen the supply chain where goods are being imported and exported. If China's ports are closed due to COVID, this will continue adding delays into global trade and raise transportation costs. So I do have some conclusions from this. This means that if the Fed were to raise rates 3 times this year, I don't think that the US economy is ready for that. It will hurt the demand side of the equation while the supply side issues are still present. And I certainly don't think that most areas of the stock market are ready for that either. Almost 30% of the S&P 500 is now technology-related companies, and a falling QQQ index will make it structurally more challenging for the rest of the index to make it up. Now, I do think the Fed may deviate from their forecast just like they changed it last year. I'm not sure that they will hike exactly 3 times like they mentioned in December. I think the impact from rate hikes on inflation won't necessarily be a clear-cut one. Raising interest rates will definitely cool off property prices as demand cools off. Housing is 10 to 15% of the core PCE index. It also happens that some of the major REIT companies like Avalon Bay and Equity Residential, the developer of luxury apartments, has rent increases baked in at 3 to 5% for 2022. Now, you know, these are the landlord developers of these nice new apartments that we're seeing being developed across the US. If interest rates slow the economy via monetary tightening, then it's likely that developers like Avalon Bay or Equity Residential will have lower occupancy rates, and lower occupancy rates has the power to slow rent growth. Now, some economists think that REITs have the ability to keep raising rents even after higher interest rates, perhaps. But if certain apartment complexes do that, they risk pricing out a certain demographic that was marginally ready to rent there. So I'm in the camp that higher interest rates will most likely cool down mortgage applications and also cool down demand for living in contemporary apartments. So will this dynamic slow down inflation? Yes. And that's because 10 to 15% of the core PCE index is driven by housing and housing costs. But what about the rest of core PCE inflation though? The other areas that are experiencing an uptick in prices are driven by supply constraints. Vehicle sales is currently being affected by the chip shortage. Other goods that are being transported from Asia or China are definitely going to see elevated prices. Those areas may or may not cool off as quickly. And that makes things more complicated if COVID disrupts the supply chain further. Then even with interest rate increases, it's possible that inflation doesn't slow down and the Fed essentially slowed down the economy while inflation didn't move much. And that, my friends, is one of the biggest risks in 2022. So now we get to the most interesting part. How do we play it from here? And here's an example slide within the slide deck materials of investment research that my future patrons will have access to. You can see here my thoughts on the outlook for the various theme baskets. Now I'm going to go into some of them a little bit further in detail. Now, for the consumer leaders trade that has worked so well in 2021, here are my thoughts. From my previous video on inflation, where I talked about Costco, Home Depot as being the consumer leaders to benefit from rising prices, those companies have definitely done very well. That said, I do think that 80% of this trade has been played out. And although Costco and Home Depot can go higher in the short term, I think that the risk reward is against these companies if they start decelerating in terms of growth. Now, their valuation multiples keep expanding, and of course this is subjective, but I just don't think that's sustainable. I do have these two companies in my portfolio strategy, and I'm looking to actively trim them later this year. That said, these two companies are potentially buys again if they correct 15–20%. I'm just simply less bullish on Costco than I was before now that it trades at a PE of near 50. Now let's talk about the financials and real estate trade, a sector that I haven't really covered much on my channel. Now, one of the best ways to play inflation is through financials and REITs. I'm personally not into these theme baskets as much, but I'll put them on my watch list since they're performing so well relative to the indexes. Now, major REITs such as Avalon Bay and Equity Residential have done very well in 2021, and because of rent growth expectations in 2022, they're likely to continue their trend in the short term. Now, the street says that these companies have pricing power because they raise rents according to market demand. And right now, wage growth is growing according to media sources. And even though I personally don't think that wage growth is that impressive, look, if that's what the street has decided to believe, then REITs do have a narrative where they're supported by strong tenants. I personally struggle to believe that narrative, but that's the narrative that everybody believes right now. One of the reasons I'm a bit hesitant on REITs is that Avalon Bay, as an example, trades at very, very expensive valuations relative to its own history. And if I'm going to pay for these high valuations, I personally would put my capital at risk in transformative tech companies. Now, let's talk about the next theme basket, high growth and high multiple, and FANG to a lesser extent. Now, growth companies are where I think the real money is made, but it's very sensitive to your timing and your entry points. And timing means that some of this basket needs to be traded and not held indefinitely, and risk management must be used in a very careful way. High growth has suffered from the narrative that inflation will make for a more hawkish environment, which reduces perceived future cash flows. I think selective companies in this basket can be incredible if timed correctly, but I'll say it again. Although this is my favorite basket, it's important to manage risk accordingly because the type of volatility you experience in this theme is not for everyone. And if you're looking for a safer way to trade this theme, then I would say the FANG trade is probably the safest. And finally, we've got Chinese internet. Now, perhaps no sector has frustrated investors more than the Chinese internet sector. I am still a believer that these companies like Alibaba and Tencent will thrive later this year, but like I've said often in my YouTube community posts, extreme patience is required. It will be really important to be selective in companies as the performance of stocks inside this basket is now really starting to diverge. And I believe things will start to turn around after Alibaba and Tencent, which are major drivers in the Chinese internet ETFs, show at least 2 quarters of strength. So this theme basket is only for investors who can, 1, afford to be contrarian, and 2, afford to be long-term. Long-term meaning at least holding it for a minimum of 1 year. I do think that we are in a bottoming phase, but this bottoming phase is still marked by incredibly high volatility with a large range. So in summary, last year, I thought inflation would be transitory, but this year inflation is a true force to be reckoned with. Yes, there's some data that suggests that inflation might be near its peak, but structurally higher inflation means that our purchasing power is now permanently impacted. So we need to be prepared for a potential Fed policy mistake. We need to be ready. This year, we really do need to do good research and be more judicious with our capital. And for those of you who want to connect with me on a deeper level through my future Patreon, it'll be ready soon. And if you like me as a creator and as a person and want to join my investment strategy community, I'd love to have you join me. A lot of cool research and strategy will be included with a whole community forum as well. But more on that in my next video. And my friends, I will see you soon.